Hey, thanks for watching. We're coming to you from full global headquarters in Alexandria, Virginia. I'm Chris Hill here with senior analysts Jason Moser and Aaron Bush. Thanks for being here, guys.
Thank you.
We're talking tech stocks. We're going to be taking your questions. First up, Motley Fool CEO Tom Gardner has put together his top stocks for 2020. It's in a report available for members of our flagship service, Motley Fool Stock Advisor. So if you're already a member of that service, you can check it out at fool.com/2020. If you're not a member of that service, head on over to fool.com/2020. Get details on how to join the service and get access to our top stocks for 2020. Let's talk tech stocks. Jason, I'm going to start with you. I know it's the start of a new decade. We're supposed to be looking forward, but I can't help but look back at the decade we just had and some of the dominant runs by some of the most dominant tech players in the business.
Well, I mean, I think that's a good exercise because you can learn some lessons, and that'll help guide our investing philosophy for this coming decade. I mean, if you go back to the market close December 31st, 2009, if you had just invested $1,000 into each of Apple, Amazon, Microsoft, and Google, and then just went about your way and enjoyed the decade and tap dance to work, as I've been so fortunate to do, at the end of the decade, you'd be sitting on close to 850% gains, just holding those four companies alone. I mean, what they have done over the past decade has been nothing short of phenomenal, but it's not surprising at all. When you look at the role those companies play in our lives today, it makes perfect sense. I don't know how easy it was to see back then, but it sure is easy to see now in hindsight.
We'll get into some of what makes tech stocks great, Aaron. But first, given what he just said, I think a natural question for anyone watching is like, okay, those are great dominant companies. Do they still have room to run? Is it worth investing in an Apple or an Amazon today?
I think so, and I think the same reasons that made these companies really the first trillion-dollar companies that we're starting to see, that a lot of those same advantages play forward. And in my mind, it really boils down to three things. One of them is just that these companies, for consumers, like, it's ubiquitous. Like, everybody can access free services like Google and Amazon. Everybody can access something like Netflix. So for, like, on a consumer perspective, like, everybody in the world can use these companies, which is what makes them so big. And really, it's also ubiquitous for companies as well. Like, we throw around tech stocks and tech companies, but the reality is that every company is increasingly becoming a tech company in its own way, using pieces of technology to innovate and improve what they're doing. And the infrastructure to make that possible, all of these companies are building on the Microsofts, on the Amazons. And then lastly, these are just like, they're really good businesses, right? Like, they're built to scale. They have super high margins, recurring revenues, network effects. Like, you could go down the list checking off the boxes of what makes these companies good, but really between like the ubiquity for consumers and companies and just the fact that they're inherently good businesses, it's made them the trillion-dollar companies, but those advantages aren't going away and should make them even bigger.
Jason, let's get into a couple of things that Aaron just touched on, and we'll start with margins, because I think for any investor who's thinking about investing, particularly in tech companies, you got to roll up your sleeves, do a little bit of math, and looking at margins, particularly when it comes to software companies, among others. But margins is one of those things that can be really attractive in a tech company.
Yeah, I mean, they can, but I mean, you also have to figure out what kind of tech company you're looking at, right? I mean, if this is a hardware company or if it's a software company, if it's some kind of a services company, because that will dictate how that margin picture shakes out. And a lot of companies, I mean, you look at something like an Adobe, for example, and I think with 85 to 90% gross margins that you see with Adobe on a consistent basis, just phenomenal. I mean, you'll love to find investments like those. I mean, you flip that over and you look at something like Apple that, I mean, for all intents and purposes right now, it's still pretty much a hardware company. And I mean, we've seen over the past several years, those margins start to come under pressure as they can realize a little bit less pricing on the device side. So it is a matter of making sure that you're comparing apples to apples and not apples to oranges. But there are a lot of different ways to play it. And there's no question that when you're talking about a lot of these tech companies, particularly as they get bigger, and when you talk about companies that scale and they can reach wider audiences and do more things without having really to invest a whole heck of a lot more into the business, you can see some real operating leverage start carrying down to that bottom line. And the bigger they get, the more powerful and profitable they become. And that's why you've seen some of these companies that have performed so well over the last decade.
Aaron, you talked about some of the companies that are, as you said, right in front of us all the time, Netflix, Apple, Amazon. But some of the companies that we've seen rise over the past decade are not as obvious because they're not consumer facing. They're behind the scenes, but they have the same attractiveness for businesses and that stickiness that we like to see. Just as, if you're shopping on Amazon, it becomes easy to keep shopping on Amazon. And some of these businesses that we look at in the B2B space, they have that same level of stickiness.
Yeah, and Amazon is one of those businesses too, right? With AWS, Microsoft with Azure, they built the infrastructure that all of these companies are building on. And there are natural economies of scale advantages to that makes them high margin. And if you look at like tech companies, doesn't necessarily equal high margins. Like there's a full tech stack of different types of technology companies, software, hardware, everything in between. So I wouldn't cling too specific to just margins, but one benefit of having high margins is that, as JMO said, more goes to the bottom line, and when more goes to the bottom line, you can reinvest in building out your infrastructure more to get even greater economies of scale. You can invest more in R&D to just move faster so that nobody can catch up with you. And all of these companies had figured that out very early, and they've just been like a commercial machine scaling in a way that others can't compete with.
I think he's made a really good point early on that we have to make sure we address, because tech company today is far different than what we'd have defined it as 10 years ago even. There are a lot of companies out there today, maybe they're not necessarily tech companies, but they're using a lot of technology to make their particular offerings palatable or attractive. Look at a lot of these payments companies. I don't know that I would necessarily call Teladoc Health, for example, a tech company, right? The primary market it serves is healthcare, right? But it's using technology in such a way that the healthcare market has really never seen until today. And so, it is a quasi-tech company, I guess. Maybe you could make that argument, but it really is important to note a lot of these companies and what they're doing with that technology. Even if they're not first and foremost a tech company, they still might qualify under that tech umbrella because of what they're doing with that technology for the end market that they serve.
Well, and we've also seen over the past year in particular, companies that come out and say, we are a tech company, and the underlying business really isn't. And yes, I'm sorry, WeWork, I'm looking at you. So how do investors begin to sort of separate the contenders from the pretenders? What should we be looking at when we're trying to decide, okay, this is a tech business that looks pretty good right now, could be great down the line, as opposed to what was, in the case of WeWork, a real estate business that was ultimately just a house of cards?
Well, first of all, you kind of have to understand which companies are misguiding you, right? It really boils down to that. There are a lot of companies that would call themselves tech companies that are or aren't. But at the end of the day, I think what is useful is almost being blind to what a company is calling itself and whether something is being called a technology company or not a technology company. I think at the end of the day, what matters most is is this company innovating? And if they're innovating, they're probably using technology in a way that helps them better serve their customers and better grow. And so in my mind, that is the most important thing that separates those that are succeeding in the future to those that are really more clinging to the past and will be those pretenders.
You can find some funny language in S1s, and 10Ks too. I think we've talked a lot about Casper, I think, here recently. It's just kind of interesting to note some of the language that they use. I think they coined the phrase sleep economy. I'm not terribly sure I'm buying into that one yet. I don't know if they consider themselves a tech company, but sometimes it just takes a little bit of a litmus test. Just use a little judgment and think, you know what, that doesn't really sound like a tech company to me. Maybe it isn't.
Think for yourself.
Yeah, exactly.
We're going to be getting to your questions in just a moment. The guys have a couple of stocks for anyone who's looking to build out a watch list. But let's go a little bit broader. Just in terms of industries that you're looking at, Aaron, I know you're a big fan of gaming.
Yeah, so maybe to back up and kind of view this macro, I think thinking about technology and technology stocks, if you look at maybe the early 2000s, mid 90s through 2015 or so, that was the technology phase of connecting the world. And then somewhere around 2010, 2015, on to, I don't know, the next few years, it's all about, okay, now that everybody is connected, what are all the things that we can do that we couldn't do before? And so some of that stuff has already happened, like streaming and social media. But I think that there is like a next phase of industries that haven't been touched yet that are interesting. So cloud gaming is one of those, real estate, education. There's so many things that are possible in industries like that. But also, when I play it forward just a bit further, we're starting to see like very early stages of the next wave of consumer technology, the AR, the VRs, that in my mind are really interesting in and of themselves, but are really just building blocks to the next evolution of the internet, which is the metaverse. And Jason and I have talked about this a little bit, but that next iteration of the internet is really about making all of these things, how you work, how you learn, how you play, more immersive, more gateways to get to it, more ways to interact, digital economies. And so trying to find the companies that are leading the way in that, and there won't just be one company, there isn't like an on button for the metaverse, right? Like it's something that will organically grow over many years, but finding the companies that are, starting to pioneer that, I think will have the biggest upside in technology.
Yeah, I mean, for me, it remains a focus on immersive technology, virtual reality, augmented reality. I mean, I have the good fortune to serve as the advisor of our augmented reality service here. And to me, we talk about total addressable market opportunities, and you see finally a lot of progress is being made on the AR and VR front. And I think for a long time we were looking for the consumer implications there, and really we've seen a lot more progress on the enterprise side of things, which is really encouraging because a lot of that technology and a lot of those ideas are starting to trickle down to the consumer. But for me, I mean, you look at the spending that has existed in the space today, $4 or $5 billion. I mean, you fast forward 5 years and you're talking about a $60 to $70 billion market. A lot of potential there. And yeah, Aaron and I we sit next to each other at work here, so we get to talk a lot about this stuff, and in line with gaming, digital economies, any kind of thing that plays into that immersive technology. That's just a space I'm really excited about.
All right, before we get to questions from the audience, let's get to two stocks that they can add to their watch list. Aaron, you're up first. What do you got?
So I'm going to start with Zillow. This is a dual class shared company, so the tickers are either Z or ZG. It really doesn't matter which one. You'll get the same returns essentially. And so talking about like how this time period is about, now that everybody is connected, what are the new things that we can do? And real estate remains one of the largest global markets that remains relatively unchanged by technology. And Zillow probably isn't thought of by most people as a hardcore technology business, but its purpose has always been to build a platform that informs buyers and sellers and connects them to agents. So it's provided useful information, but the core business has traditionally been to serve that old guard. That's all changing right now. And they're really leaning into iBuying, which is building software and systems that allows them to innovate on the transaction process itself. And this is a huge opportunity that really only a handful of companies, in the US at least, are equipped to lead, and Zillow has a few advantages there. And so far, they've started this. It's led to a major acceleration in their revenue. It's also led to higher losses. And what I think investors could be missing out on is the idea that, yes, technology makes this possible, but economies of scale makes it viable. And we haven't seen those economies of scale kick in yet. So what Zillow could look like in the future is probably a lot different than what it looks like today. Of course, it's not guaranteed. There still is a good amount of risk there. But in my mind, it's really interesting because if they get it right, the potential upside is pretty extreme.
What about you, Jason?
Yeah, I'm going to go with the top performing stock in our AR service today, and I've got 20 recommendations in the service right now. The top performer since we opened last June is Lumentum, and I think it probably flies under the radar of a lot of folks out there, but this is really part of the backbone of that augmented reality, virtual reality technology. They're known as the leader in, this is going to be a mouthful here, VCSEL. All right, you got that? Does that make sense for you?
No, it doesn't.
Vertical cavity surface emitting lasers, and these are little lasers, chip-like really devices, components really that go into our smartphones. The nice thing about Lumentum is it's phone agnostic. You'll find them in iPhones and you'll find them in Android devices, which is really nice. But you look at the VCSEL market. It's going to grow from $4 billion. It's going to grow to $4 billion in 2023, up from about $1.8 billion in 2018. So I'm always a little apprehensive when it comes to these components companies, because you can see reliance on big partners like Apple can result in some margin compression because they lose a little bit of pricing. But when you talk about the runway that exists for this technology and the fact that it's going to expand beyond phones, and then you look at the fact that Lumentum really is the global leader in this space, I just think there's still a lot of opportunity there for this business. And certainly the China trade war, I think, has created a little bit of uncertainty, and I think that's actually played out on the stock a little bit. It still performed very well. I feel like there are a lot of tailwinds for this business. And again, like I said, it's the top performer in our AR service today.
All right, if you're enjoying the video, please consider giving us a thumbs up. It helps other people find videos like this, and we like doing videos like this, so we appreciate the thumbs up. And again, go to fool.com/2020 if you want to get Tom Gardner's top stocks for 2020. Let's get to the questions coming in. A lot of great questions. First up, Sandeep, who asks, I know you guys like Mercado Libre. Are there any other good tech stocks outside the United States? Mercado Libre, big e-commerce player south of the border.
Yeah, Mercado Libre, I think we've always known as the e-commerce play of Latin America, kind of the Amazon of Latin America. If you look through their results here recently, this is clearly just as much a payments company as it is an e-commerce play at this point. So beyond Mercado Libre, when you look at Latin America, Brazil in particular, the opportunities that exist there, StoneCo, which is a payments company that focuses on Latin American markets, I think is a really interesting idea. It's a stock I own personally, and it's certainly gaining a lot of traction as the tailwinds and electronic payments continue to pick up.
Yeah, another payments company is Adyen, which is based in Amsterdam. There really are so many. Yeah. I think Australia is a gold mine for lots of software companies and payments companies that most of us here don't even really pay that much attention to. And of course, China. There are now more Chinese unicorns than US ones, which is a pretty remarkable statistic. And so I think, a lot of investors are concerned about China, especially with headlines like trade wars. But there are companies there, big and small, big like Tencent, and smaller like various streaming companies and such that are doing all types of things. So they're all over the place.
A couple of people asking about regulatory challenges, big tech stocks like Amazon and Apple being broken up. Is that something you factor into your thinking when you're thinking about whether or not to buy shares of these companies? Great question, because it certainly has gotten a lot of coverage.
Yeah, I think it's absolutely worth thinking about. I think the problem is that a lot of the old regulatory rules really struggle to apply to today's modern environment because there just hasn't been anything like it in the past. And what makes, if you consider something like Google, Alphabet a monopoly, is that unlike the monopolies of the past, like the US Steels or something, those were supply-side monopolies. They controlled the supply and left few options for everybody. These services, like Google and Facebook, they're free, right? It's hard to split things up that are free, or it wouldn't make sense to, because people choose them for a reason. Where I think it becomes problematic is, yes, at some point you need to stop someone like Facebook from acquiring another network. And yes, for a company like Amazon, you need to watch closely to make sure that they're not using contracts to their advantage with suppliers, for example, keeping them from selling on platforms that aren't Amazon and using their size to the disadvantage of other players. So in the big perspective, I'm really not that worried, but of course I don't really, I also wouldn't trust our regulators to necessarily make the right decisions, mainly just because the laws are ill-equipped to handle today's environment.
Well, and I talked to one tech analyst a couple of months ago who threw out the possibility that Amazon would proactively spin off Amazon Web Services as its own company as a way to avoid regulatory challenges. And in his way of thinking, he said, if they spin off AWS, that could be a $500 billion company on its own.
Yeah, there's no question it could be. And I think that's, when we talk about regulatory concerns and the potential for companies being split up, I think the default is to think that's a bad thing. The fact of the matter is that doesn't always actually have to be a bad thing. It could very well be a good thing. And if you saw Amazon split up, for example, you have AWS and then you have the core Amazon business, I mean, I can come up with compelling reasons to stay invested in both.
Question from Eric, who says, you mentioned gaming. Do you think Sony is a good stock for the future? What stocks do you like to capitalize on esports and video gaming?
So I can't really speak to Sony in particular. I know that they've had a really strong year. Maybe Jason knows more about them. In gaming, PlayStation is fine. I don't think they'll have a strong next console generation, which launches this next holiday season. In terms of esports, I think esports is generally overrated because the value chain favors those who own the sport. Because unlike something like the NBA or basketball or football, nobody owns football. But for something like League of Legends or Call of Duty, there is a company that owns the game. And so when they build esports ecosystems, it's naturally going to favor them, right? So it gets tougher. But I do think that if you look closely at a lot of the big publishers out there, they're really outstanding companies. And I would just throw a company like Zynga out there, which is a leading player in mobile gaming, which mobile gaming is the largest and fastest growing component of gaming. And maybe it doesn't sound as spicy as esports, but it's a much better business.
John asks, what are your thoughts on Uber? Uber really and Lyft both seem like businesses that if they went away tomorrow, we would miss them as consumers. But right now, I don't know that we would miss them as investors.
I feel like they're better services than they are investments. Now, that certainly could change. I think it's going to be a matter of ultimately what they do with those networks. I mean, right now, it's kind of plain to see what they do in their ride business, and I think they're dipping a toe in logistics and whatnot. Food delivery seems to be a little bit of uncertainty there. I know that Uber recently sold its food delivery business in India just because the economics didn't really make sense. I mean, I feel like they're better services than investment ideas right now because the economics just aren't compelling. And you can see there are certainly regulatory risks from the perspective of states wanting to change the laws regarding this gig economy and into making these companies protect their employees more. So regardless of where you fall on that issue, I mean, that certainly is something that could make the economics of the business even more difficult than they are today, which obviously wouldn't play out well for investors. So for me, I'm having fun learning about them, but I have zero interest in investing in any of them right now.
One commenter asks, I see a lot of companies throw out a huge TAM, total addressable market, a huge TAM number out there for their growth story, and it's really hard for me to understand how realistic those are. How do you guys dig into those? Great question. You mentioned Casper before, and I don't want to pick on Casper, but they seem like only the latest company that when they file their S1 to go public, they refer to an enormous total addressable market. And it's a great question because it's like, well, some of those can be reasonable and some of those can be really pie in the sky.
Yeah, I think some businesses are a little bit more proven and you can take that total addressable market to heart. Other businesses that have not proven themselves yet, I have a general philosophy. I look at that TAM that they quote and I basically give it a 40% haircut. And then I look at it from that perspective and I say, okay, now, assuming that this is a 60% of what they're saying it is that still an attractive market? Is that still reasonable? And that can help me determine whether this is an idea worth pursuing. But yeah, if you take them at their word, you're setting yourself up for some trouble.
Do you have a trick like that?
I mean, somewhat. I mean, I think what is compelling is if you can cut it by 40%, and it still is big enough that you're just like, okay, that's compelling. But really, you just got to think for yourself. Like so much of it goes to that. Like Planet Fitness is another example where they throw out like a massive total addressable market, and it's something like these are all the people who are exercising, but how many of them will like choose a gym and then within like gym choose Planet Fitness? So. You just have to narrow down based on that, but still a small company, a massive market. Even if you cut it down by a huge amount, you can still see how they could expand internationally and do all these cool things.
I mean, go through that WeWork S1 and look at the total addressable market they quote. I mean, you don't even think really there's that much money that exists in the world. These numbers are so big. So yeah, that will certainly make you think. But yeah, I mean, you just got to be able to think for yourself in some cases.
I love this. I'm going to take a page out of the playbook of all these CEOs. The total addressable market for this video is the entire planet. Anyone who has internet access. Let's make it happen, people.
I mean, you're not wrong. You're not
Billions.
wrong.
We could get billions of views on this.
We could argue it, but you're not wrong technically.
A question from Pavel Simo, who asks, what are your thoughts on space tech companies like Virgin Galactic?
God, I love space. I'm just the biggest space nerd. I watch space documentaries on TV, and I think about that stuff all the time. So for me, I mean, this is a space, no pun intended, where I would love to invest. I'm going to be excited when more ideas come to fruition. It's such a young market right now, and I mean, I don't know that there are very many ideas out there that I'd be all that terribly interested in right now, but I will recommend, go check out Space Angels. This is a venture capital group, and they basically pool a lot of money from qualified investors to invest in this industry. So a lot of the money they're investing is in companies that are not public right now, but I think a lot of these companies will be on that radar, and we'll see some of those ideas go public at some point here in the future. But if you check out Space Angels, you'll get some really great information there.
Yeah, I think it's early. Most companies are private. But it's worth paying attention to because space is hard, right? And
Well, yeah, it's all the way up there.
Elon said that, I remember, and so did Jeff Bezos.
Space is hard, and if you can find a business that is a viable business economically, odds are really high in this industry that the barriers to entry are just like so extreme that there are only a tiny number of companies in the world that can compete. So something like Virgin Galactic, I actually don't know that much about the business, but I can guarantee you, how many competitors do they have, right? Like maybe like one or two at some point. So the stock's been phenomenal. It's like doubled in the past month. I don't know how sustainable that is, but it's worth digging into for sure.
I absolutely would recommend reading that book, The Space Barons, and we had a chance to speak with the author of that book, Chris Davenport. He's with the Washington Post, is that right?
Yep.
Just a tremendous book. It talks about Elon Musk, Jeff Bezos, Richard Branson, and I think Paul Allen too, and all of their efforts into figuring out how to get an edge in this space market. And I mean, to Aaron's point, space is hard, but man, the folks that are out there working on it now, there's a lot of money going into it, and once you figure out how to crack that nut, the barriers to entry are going to be a phenomenal competitive advantage.
A question from Ivan, who asks, do you guys have any interest in blockchain technology, and are there any easy ways to invest in it?
Well, yes, I do. Yeah, a couple of years ago, I started a service called Crypto Society, which focuses on researching cryptocurrencies, finding investments that leverage blockchain technologies, decentralized technologies to just find ways to improve their business and scale in new ways. And I absolutely think that it's fascinating. Probably the best way to invest in it is just buy Bitcoin, which is the dominant cryptocurrency, the safest, the one of the most interesting. If you want to put in a lot of work, you can go through others like Ethereum and such. But there are also like companies out there that are leveraging this technology in interesting ways, like DocuSign with e-signatures. They're able to, if you use one of their services, you can sign a contract onto the Ethereum blockchain where it is secured and can't be tampered with. In general, I think we've seen the hype cycle play out. There was a lot of speculation interest that drove prices up. It's, for the most part, bottomed out, and I actually think now is a really good time to be thinking about, okay, now that 99% of the casual observers are no longer observing, all who is left are the builders and the people who really know what's going on, and these people are building cool things, and it's worth paying attention to. There are some public companies that do stuff. There's different cryptocurrencies, and there's a bunch of private companies too, but it's definitely something that's going to grow more important, and also is a building block for the metaverse that we talked about earlier. Digital economies will be powered by digital money, and so it's interesting as its own industry and as a building block.
All right, Aaron Bush, Jason Moser, guys, thanks for being here.
Thank you.
Thank you again for watching. Again, go to fool.com/2020. You can get Tom Gardner's top stocks for 2020, and thanks for the thumbs up. We really appreciate it. Don't forget to hit the subscribe button. It's free, people. It's free to subscribe. We're going to be back here next week with another YouTube Live. For everyone here at The Motley Fool, I'm Chris Hill. Thanks for watching. We'll see you next week.